The Union Budget 2026, tabled in Parliament by Finance Minister Nirmala Sitharaman on the 1st of February, has curiously proposed to revise the sovereign gold bond or SGB taxation rules for investors who are not subscribed to the original issue. According to the new proposal, capital gains tax exemption will only be available to taxpayers who subscribe to the bond at the time of original issue and then held on to them continuously until maturity right up to redemption. Specifically, the Annexure B of the Budget Speech 2026 document says the following about the SGB taxation, and I quote, "It is proposed to provide that the exemption from the capital gains tax in respect to the sovereign gold bonds shall be available only where such bonds are subscribed by an individual at the time of original issue and are held continuously until redemption on maturity." It is also proposed to provide that this exemption applies uniformly to all issuances of the sovereign gold bonds by the Reserve Bank of India, unquote. This budget proposal is said to impact taxpayers who invested in sovereign gold bonds through the secondary market. The announcement in Budget 2026 is a departure from the previously understood taxation of capital gains from the gold bonds. As per the original rule, only the interest on the sovereign gold bonds was taxable, while there was no capital gains tax on maturity proceeds. The SGB scheme offers 2.5% interest per annum to its investors. However, Section 71X of the Income Tax Act 2025 has now been proposed to be amended to clarify that, and I quote, that the exemption from the capital gains tax shall be available only where the sovereign gold bond is subscribed by an individual at the time of original issue and is held continuously until redemption on majority, unquote. The exemption will no longer apply to sovereign gold bonds acquired through transfer or purchase in the secondary market. Here's how the taxability of the gold bonds will now work. Gold bonds purchased at the time of issue and held until maturity will be exempt. Gold bonds not purchased at the time of issue but held till maturity will be taxable. Gold bonds purchased at the time of issue but not held till maturity will also be taxable. And gold bonds that are neither purchased at the time of issue nor held until maturity will be taxable.